when China occupies such a large portion of the Asia emerging market basket, when there's disenchantment with China, it's a big boost for all emerging markets, ex of China, including India. So, Prashant, you've done some piece about the flows into the emerging markets, China, India. Stack them up for us.
I mean, I'm just going to present newspaper headlines, nothing more, no analysis, no flows, but just headlines, right? And by the way, on that point about disenchantment with China, here's a stunning statistic. I just looked it up on Bloomberg. Chinese mainland markets, the benchmark, is up 14% from the COVID lows. India, this is dollar returns, and India is up 101%. 14 and 101. So I think, it's very clear where the money has been moving to. But let me just go across to the big wall and tell you, the retreat that foreign investors seem to be making, right? I mean, I don't want to make it sound dramatic, but that's what it seems like. At least the indications are. So I just picked up Financial Times is a global, well-respected newspaper, and these are the headlines over the last 2 or 3 weeks that I've pulled up, right? Look at this one. China has cancelled for many foreign investors. Let's look at the next one. Clients rush for Asia investment products that exclude China. Prashant was just kind of hinting at that. Look at the next one. Pension funds recoiling from China, say a Dutch asset manager. Another one, demand grows for Asian investment products that are ex-Japan and ex-China. So this is just the last 2 or 3 weeks, and I could put out many more, but it kind of tells you which way the wind is really blowing. But the question is, why are we seeing the retreat from China? Remember, we've been talking about this China plus one theme, at least for the last 2 years or so. But we've spoken about it mostly from a manufacturing point of view. That, bulk of the manufacturing happens in China, but now we need manufacturing outside China as well. But this China plus one is also true from a flows perspective, portfolio flows perspective, and that's essentially what I'm talking about. But why is this happening, right? Geopolitics and economics are the key drivers here. Economics, we all know. I mean, Chinese growth has been, subpar for some time now. So I'll focus on geopolitics, which I think is the key driver here. For many investors, the US-China tensions are a reminder of the fate of those who backed Russian companies. And we know what happened, right? For companies investors who really backed Russia after the Russia-Ukraine war. I mean, basically, investments went to zero. That's a very stark and very recent reminder of what can happen if this rivalry between US and China continues and actually picks up pace. US is actively now trying to reshore, bring investments back into India, back into the US, and curtail the development of critical industries like semiconductors, etc., in China. So, I mean, US, for example, the government passed the US CHIPS Act. We can talk more about that later. US government is considering restrictions on US investments into China, especially in critical sectors. And just in May, we had a statement, an unprecedented statement from G7, the summit, which basically said the intention is to de-risk from China, from chips to minerals to everything. So I think, it's not just the US, it's basically the entire Western bloc. And we are kind of entering a new kind of, multipolar world, which I think at the margin perhaps benefits markets like India. Look at what funds are doing. And again, this is all based on reports that we've picked up. Ontario Teachers Pension Fund cut back positions in China. Sequoia, the global VC giant, split its China business into a separate entity. The famed investor Warren Buffett sold 50% stake in BYD, which is the electric car group. He also bought and very quickly sold a stake in TSMC, which is the world's most important chip maker, because of fears of China. GIC, the sovereign wealth fund, has slowed down its pace of direct investments into China. CDPQ, which manages some $300 billion in assets, closed down its Shanghai office. And of course, I mean, as I said, there is real growing demand, mandates for new Asian investment products that exclude China as a market. Just ending with MSCI emerging market weights, China is 31%, India is 14%. The hope is that if China goes down a couple of percentage points, India naturally will pick up a couple of percentage points, and that means tens of billions of dollars over the next couple of years. This is not a 1 day, 1 week, 1 month story, but it will play out over a period of time. Prashant, just kind of very quickly